Alan, are we live? Okay. So this is a little presentation to go over the talk given by Michael Lipkin and Marco Abbagiata in Paris of 2011. Basically, he's talking about stock price pinning near option expiration dates. And that's really only where you have pinning is near the expiration dates. There's a few conditions that you need for pinning. You need very little time left before expiration. You need a relatively low volatility, and you need for the price to be close to the strike price, and we'll see why. Okay, they go over some empirical charts, histograms that they did to analyze empirically the probability of pinning and to validate their model. They have a linear price impact model and a nonlinear one that is basically power law impact function. Basically, P is the power, and they call 1/2 the phase transition. You'll see why. But 1/2, P equals 1/2, it seems to be the boundary point or the phase transition point where if it's less than 1/2, the probability of pinning is pretty much zero. And if it's greater than 1/2, then there's a probability of pinning that's likely less than 1, but greater than 0. He goes through some of the mathematical proofs as well. We're not going to get too mathematical. It's just basically a more of a qualitative approach, but to understand the basic formulas in math is something that I'm going to try to do. Okay, so here's his chart example, very simple example. The strike price is $12.50. For stock A, stock B, the strike price was 15. Or if it was $12.50 as well. We see over here that A pinned and B didn't pin. It would be helpful to see how much time, when did they start tracking this, but I think like a couple days before, like the day before or 2 days before. You don't want to go much further than that. It would make sense to do 5 days or 10 days before expiration because the deltas are not going to be as large as they would be when you get closer to expiration. There's less time, there's less theta, there's more gamma. So gamma is a sensitivity of delta. So delta is going to be going up quite quickly as we get close to expiration with little minor stock moves. So okay, he uses Ivy, which is an end of day options database. It's a little hokey because it's hard to trade on the end of day prices. So it's better if you have a database with intraday data, obviously. And he looked at CBOE statistics as well. Now, obviously, the stock has to be optionable. They compare optionable to non-optionable stocks. If the stock doesn't have an option, then pinning doesn't apply because there's no options for it. The whole thing is when market makers are net long or possibly net short options, and then they have to sell or buy stock to hedge. Okay. Here's non-optionable stocks. We see it's basically a uniform distribution. There's no skewing of any kind. There's no convexity. It's all like a flat line, more or less. So there's really no pinning over here for non-optionable stocks. For optionable stocks, we see a little bit of a normal distribution coming in here. Here it's more pronounced. So we say it doesn't have to hit the strike price, but within a quarter of the strike price. We're talking about American stocks. He analyzed a good cross-section of American stocks within a quarter of the strike price. If they expire within that threshold, it's considered a Okay, here's another example, non-optionable stocks. Here he uses a finer threshold. He uses 12.5 cents for optionable stocks. Of an integer multiple. Okay, so some multiple of 12.5%. No, wait, that's not true. 12.5% of an integer multiple of $5. I'll have to ask him about that. Okay. So the threshold is a little unclear what he's using and why. Anyways. All right. Okay, demand for deltas. So it all depends on demand for deltas that market makers, for our example, their net long options, open interest is large. And as a result of that, there's a demand for deltas as you get close to expiration and the delta starts to change. Obviously, if we're far away from expiration, the delta is going to change a lot less. Or if the strike price is far, if the current price is far away from the strike price, then the delta is going to be close to zero as you get close to expiration. Or if it were way in the money, it's going to be 100. So the delta will either be 0 or 100, in which case there's really nothing for market makers to hedge. Okay. 0.125, yeah. Do you think that's what he's doing? Let's see if he does that for optionable stocks. Yeah. Okay. So because he doesn't know exactly where the price is going to be, what strike it's going to be close to, so he analyzes a bunch of different strikes. I think that I'm not sure if he's doing that. It could be. Kind of makes sense that he would analyze multiple strikes. Okay, so this is a general impact formula on the way of expressing it in terms of symbols. So we have DS is the change of the stock price over S, so it's the percentage change of the stock price, and that is proportional to some E, which is an elasticity or a sensitivity parameter. D would be the open interest, which would be open interest or demand for deltas, and V would be like the total average volume, open interest for the day, or possibly volume. P is that power law effect coming in, that parameter P. It looks like he tried different levels of P. That's what this whole talk is about, this lecture rather, is what value of P do we need to start to get pinning? In other words, the price impact function is going to be nonlinear. It's going to be power law based, and they want to know, well, P is basically the level of nonlinearity. How nonlinear does the price impact function have to be? So price demand elasticity. So here what we have is another way of expressing it in terms of the price percentage change is proportional to elasticity or sensitivity parameter times the open interest divided by the average daily open interest. Open interest, you could possibly be thinking about that as maybe demand for deltas as well. But I think demand for deltas is more on the stock side, is how much stock is going to be sold to offset the delta change in the long option position. Here's a way they express the change, the price change with respect to the change in delta. So this delta is the Black-Scholes delta for one option. That's this delta, mathematical delta symbol here. Okay, estimating demand for deltas. We use Black-Scholes because that's generally what people use. It's popular. We assume market makers who are delta hedging are using something like Black-Scholes, something close to it. TOR is the time left to expiration. So capital T is the expiration time, and we subtract the amount of time that is left on the clock. So the change in delta is the partial of the Black-Scholes delta with respect to t, and multiplying that by the change in time. Okay, I don't think we have to go through this. Y is the distance or the moneyness of the option. If you talk about options, Y is the moneyness. If you talk about dynamics of stock prices, it's the distance that the current price is away from the strike price, and it's log scaled. Okay. We're using normal distribution. We're assuming normal distribution from the A here. As we see over here, the E to the minus. It's kind of a skewed normal distribution. The Y parameter is the distance away from the current price is from the strike price. So that kind of skews the normal distribution a little bit. If Y is very big, right? So this probability is going to be pretty small. Since this numerator is going to be big, the variance is generally going to be small because that's one of the assumptions. And tau is going to be small. Tau is going to be small because we're close to expiration time, and the variance and the standard deviation, the volatility is going to be small because that's what we need. If volatility is large, the stock's moving too quickly to know what strike price it's going to be, the current price is going to be near, because it's going to be whipsawing between a bunch of strike prices, most likely. So if Y is big, then the change in delta, well, then this parameter over here is going to be small, which means this whole thing is going to be large. Or is that not true? Let's think for a second here. This is all in the denominator. This is the numerator. Numerator gets big. Denominator is big. So the whole expression is small. So it doesn't become too much of a factor. So then the change in delta is taken over by this stuff here. So if Y is big, the change in delta is not so great. That's what we're saying. It's inversely proportional. As the distance gets smaller, that Y gets smaller, the distance between the current price and the strike price is smaller, the deltas change at a greater rate. And that's all that's helping us say over here. Everything else is all normal distribution type dynamics with another, what we call restoring force put in here so that we don't always pin. So we say if we're far enough away from the strike price, then there's a very low probability of pinning. We'll see that later in the probability measure. Okay, so here's the dynamics for the stock price. It's the change of the price over the price, so the percentage change of price times the sensitivity parameter times open interest divided by the average open interest times the rate of change delta with respect to time times the amount of time, the time change, the amount of time that is passed already, or time left, perhaps, plus a noise. So standard deviation times Brownian noise. So this is our noise component. Here is our moneyness distance component in Y. So the change in Y, how does the stock distance or the price, how does the price of the stock change with respect to these forces? So we have a coupling constant, which is basically sort of like a pinning force. And then we have a restoring force here that says that we don't always pin. It depends on the distance. Volatility is low, but it's thrown in here, but it's relatively low. So it's not so much of a factor that the Y, the distance, becomes more of a factor than the sigma, which will keep at a constant. It's not really constant, but when it's low, you could approximate it as a constant because it's not going to change that much. This is a skewed normal distribution with the Y factor causing a bit of a skew. This is our bounded support and our noise over here. So noise, bounded support, meaning you're going to see in the probability measure, it's going to limit what the ceiling is for the pinning probability. So a normally distributed dynamic with a restoring force, with a coupling or a pinning force constant. Okay. Does some Monte Carlo simulations here. This is basically what the actual distance would be from the strike price on your different simulations. So here you have days to expiration. You see basically, he starts actually 9 days before. Starts about almost 2 weeks before here. And he's using log time scale, negative log time scale. Okay. So this is where you have the perfect pin over here. This is where it pins. In other words, the distance to zero means the current price is at the strike price and there's no time left. So that's why this is circled. This is the pin over here. So you see that in Monte Carlo, there's not too many situations where it actually does pin. Okay. We'll see later on it's close to 25% maximum, 15 to 25% maximum probability for the pin, any given American stock. Okay, but that's what Monte Carlo is showing us. Okay. Here's a cumulative PDF. Here's the pinning. Here's where we actually get the pin. Z is like a pinning force or pinning behavior. We'll see what Z is in a minute. But basically, it's Y. It's the distance over over the volatility or standard deviation times the square root of the expiration price time. How much time is left? So, which is another. This is all volatility at the bottom here, scaled by the square root of time. That's how volatility is normally scaled when it comes to time. And up here is the distance. So this is the pinning behavior. In other words, this is the way the stock behaves as it gets close to expiration. In other words, these are the factors that affect pinning. You could say it's the stock pinning behavior. Okay. So just dimensionless type formula. So we're shifting, we're actually doing a transformation into Z space, if you will. And what comes out is when we do the transform to Z, we wind up with a similar, so in other words, beta becomes our pinning force, which was that coupling constant before. S becomes a ratio of the current time to the expiration time. Z naught is a specific point in time. All right, it's like when you have a Z naught, it's like a parameter, it's like a constant. Okay, alpha is sort of a volatility parameter here. So anyways, this is our linear impact function. This is showing what happens as we get close to expiration. We have the Z force, the Z price, a stock pinning behavior. This shows a parabola of prices with noise. So it's a cross section. If you take a cross section, it's an interval of prices. And as you get close to, this is the strike price, as you get close to expiration. So I guess this would be expiration. This would be the pinning force of the stock, of the market makers doing their hedging by buying or selling stock and forcing the price towards the current price towards the strike price as you get closer to expiration. Okay. And we looked at the change of Z, the pinning behavior with respect to S. S is the current price. Or here, big S is the strike price. I'm assuming little s is the price as we converge on the strike price. So I'm sorry. let's go back to that. You're right. Yeah. Thank you. So big S is the current price. Little s is the ratio of times. Thank you for that. Okay, we're going to skip most of the math over here. We get to this formula. Okay, this is the punchline. This is the probability of pinning formula that they come up. If you want to go through the differential equations yourself, you can do that. We're not going to do that now. So the limit as s goes to 1, right? So in other words, big T is 1. That means it's expiration, right? So big T is 1, I would think. And then S is going to that time. So we're going to expiration. So the probability of pinning given Z is, according to this formula, is going to be 0. You can work out the math. 1 minus 0 is going to be, 1 minus 1 is going to be 0. In the denominator, that's going to blow that up to infinity, but that's in the denominator, the E minus thing, so that's going to be 0. So that whole thing goes to 0, which means it's E to the minus 0, which is 1 basically, so it's 1 minus 1, which is 0. And then the other probability limit as S goes to 1, if you plug in Z is 0. So Z is a pinning behavior, basically. Those are the factors in Z are volatility and distance. So if all that's 0, that means the distance is basically 0, and we're at we're at expiration time, and the current price is a distance of 0 away from the strike price. That's just a way of saying we pinned. So that probably has to be 1, because this is, you understand, the second limit is just saying that we pinned. So we plug 0 in for Z. So what do we get? So we get, and then limit, so we get 0. We get 0 over 0 there, basically. But it's the limit as it approaches 1. But you actually have 0 up there. So anyways, you can work it out. It comes out to 1. I think E to the 0 is going to be 1, and then S is converging to 1, and that makes the bottom, the denominator here is going to be 0. That blows this up to infinity. E to the infinity goes to the denominator here, which is 0. So it's 1 minus 0. The only little suspicious thing is over here, S is going to 1, so it's 0 over 0. So you'd have to do some L'Hopital's rule or something. You'd have to, it's kind of an indeterminate form, so to speak. So you might have to actually differentiate once under S, I suppose. S is the parameter, Z is held fixed. So if you, yeah, it gets messier. I don't really want to go through that now. Okay. And here is a conditional probability over here. This is how it's expressed. Pinning is dependent on beta. That makes sense because beta is the pinning force. It's almost exactly linear with a minor bend in it. Let's get to the punchline. Right. So this is the probability of pinning. At the most, it's between 15 and 25%, but the upper bound's around 25%. So it's not a good thing to do to make money. You can't make money doing this. That's what they discovered, right? Is that the probability of pinning is only 25%. You saw it with Monte Carlo. it was maybe even lower. The Monte Carlo example that we saw, if you go up again, was maybe 10%. Visually, if you look at it, here's the ones that pinned, not so many, okay? And the thing is that if it pins, you make a little bit of money, but if it doesn't pin, you stand to lose quite a bit of money. Plus the probability of pinning is low. So what I suggest that we do is take the price impact, that function, the dynamics function, which was getting back to this guy here, and seeing if we can relax the conditions and figure out some kind of generalized price impact function for stocks and indices. Right? So we'd have to relax certain conditions. We'd have to relax the condition that we're near expiration. And then the condition, low volatility, we could possibly keep that condition, and it'll be only a formula for analyzing more or less the drift. When we're talking about having a low variance, when the variance doesn't come into play because it's low, then the drift has more significance. So possibly we could keep the volatility assumption. We'll have to get rid of the short time to expiration assumption, and we'll also have to get rid of the price is near the current strike price. So we won't be able to rely on market makers doing delta hedging, which really blows a lot of this stuff out of the water. But perhaps, through empirical analysis, we could come up with some kind of fit for the data with a large enough sample space over time that approximates something like this, right? There's definitely going to be noise. There's definitely going to be like kind of a skewed normal distribution of some sort, although Y will have to mean something else for us. And then there'll be other forces acting to further skew away from the regular normal distribution. That's really all I have for this talk. Anyone have any questions? Yes. The thing is, what is Y? In other words, should Y probably not have a strike price in there? Or if it has a strike price, we're not near expiration. So like, what's the point of modeling Y with a strike price? So this is, a log scaled moneyness ratio or distance ratio, however you want to look at it. So our Y, we may have to define Y differently, and that might be one of the first tasks, is how do we define Y in a way that's more generalized, that doesn't depend on expiration. Because the K means that we're basically dependent on expiration because we're looking at a strike price. So unless we find a way to incorporate strike prices in a way that somehow doesn't depend on any particular expiration. But then it might have to be like a whole gamut of strike prices. It doesn't seem like that would be something that would work out. So our definition of Y would change. Right? Our definition of sigma might stay the same. Y would change, and the time to expiration would probably be removed by something else, right? Capital T minus little t wouldn't make sense anymore. But, it's just a way to start thinking about how we might develop some IV price impact function. Or we could have a open interest price impact function, perhaps. Or I think open interest itself may not be such a good indication of what the price is going to do. But we'll have to model that empirically and see if there's any significance to open interest spikes on the price. Any other questions? All right, you could stop the recording now, Alan.